Hello, welcome back to Life Insurance with Infiniti, aka 56 in Finance. Today I'm going to be telling you guys about the difference between term life and whole life insurance. So if you're new to the whole life insurance thing, it can be kind of daunting to sort through your options on your own. If you don't know a life insurance agent or know of a life insurance office, if you reside in the state of Missouri, I can help you out with that. That being said, today I'm going to talk about term life insurance and whole life insurance in their simplest definitions. Okay, so term insurance is super just streamlined. It covers you for a specific amount of time. Typical plans span anywhere from 10-year, 25-year, maybe 30 years, maybe 20 years, somewhere in there. Those different time frames. And what that does for most people is it covers them for a specific stretch of time. So in the case of mortgage protection, which I specialize in, it usually covers families for, let's say, their working years or for the term of their mortgage. But it doesn't just have to apply to mortgage coverage. Term life insurance can be customized to span whatever length of time is most needed by the client. And it's typically way cheaper than whole life insurance because it doesn't have to insure you for the entire span of your life. Some things to think about with term insurance is that if you outlive the term of your policy, it doesn't pay anything. In some special cases, and you want to defer to your insurance agent or broker, in some cases we do have what's called return of premium, which means that if you outlive the term and you have return of premium set up, once that term expires, it'll pay back either a percentage or the entirety of the premiums you paid into it. So if you've been paying $50 for 30 years and you outlive that term policy, you're due a paycheck at the end of that. Also, if you outlive the term, your beneficiaries do not receive a payout for your passing, which is sometimes a concern with older clients. Most of the policies that I write for term are level coverage, so that means that premiums stay the same as well as the death benefit throughout the term of the policy. In some special cases, people will set up a term policy that decreases over time and basically matches up with the financial obligation that they're trying to get coverage for. So again, when it comes to mortgage protection, if you owe out for 20, 30 years on a mortgage and you get a decreasing term policy, that means the amount of coverage goes down with the amount of the mortgage balance that you owe. The great thing is that most of the carriers that I am contracted through do carry some form of term product. It's very popular among young and healthy adults who have either just bought a house or they just want coverage for a specified amount of time due to work or other life circumstances. Let's talk about whole life policies. Whole life policies are a whole nother horse, and obviously they last you your whole life. So unlike term, whole life policies are known as permanent policies. So these have expiration dates of about 90, 100, or 120 years. One carrier I write for has a term of about 121 years. Needless to say, that's when the policy would mature. Unlike term policies, whole life policies grow cash value. So that means if you survive the policy by the maturity date, so on average, most policies will mature at the age of 100. If you live to be 100 plus, they will issue you out the cash value for that life insurance policy, which is typically the face value of the policy. A lot of the whole life policies that I issue out are also known as final expense, and it gives families the breathing room to deal with any end of life expenses, because unfortunately, we all pay to die. So you know, when you pass away, there's a death tax, there's often estate taxes that you have to go through. Sometimes people end up going through probate, which can be costly. It just really depends on what all you had together when you passed away, but either way, it's kind of pricey. Whole life policies are super popular because, again, they are level, so that means your premiums don't change and your face value also does not change. They grow cash value, as I said, which would pay out if you survive the maturity age of the policy. And just generally, people tend to set and forget whole life policies and just continue to pay the premium on it. And that's why it's handy to have a dedicated insurance agent at your side, because they'll pop in every now and again and just remind you, like, hey, you still got this policy in force. How are you doing? You're good with your coverage, etc. Just be cautious of taking out loans against the policy, because even if you don't pay the loan back to the policy, that means that the face value of the policy will decrease by whatever loan amount. So if you have a $25,000 loan, so if you have a $25,000 policy and you take out an $8,000 loan, well, if you pass away, your beneficiary only gets the difference of that, minus interest. Every now and again, I get asked whether whole life is better than term life or vice versa. And to be honest, it is a completely individualized experience. For me personally, whole life policies are invaluable. Just because I know that if anything were to happen to me, I have this foundation of funds. I have an estate where my family could put me away and be okay after I'm gone. However, if I could qualify for it and I was about to take on massive expense, say as a mortgage, I could see the value in a large term policy. Because I don't know if you noticed, but the prices on mortgages and the monthly payments are astronomical. And I wouldn't ever want to put a monthly mortgage payment on my family